Hey everybody, welcome to the video podcast that we're doing today. We're obviously don't do as much video as we used to. They're a little more time consuming to put together, but obviously with markets moving as much as they are, we wanted to get this out to you just like we did, I believe it was Monday, I guess. So here we are on Thursday, and what started as a little bit of a interest rate scare has turned into all-out selling now. And so this is really where the rubber meets the road between investors. So we're going to spend a little time talking about what we see coming up. And really this is following a very similar pattern, which I'll show you in just a minute, going back to 2011. And what we're looking for, and you can see right off the bat, this stock market is really giving up, I would say, probably from right here when it started to really go vertical. That was really the market pricing in tax cuts, I believe, and started to get that we were getting better economic news. And then the news happened, right? We had the tax cuts go through. We had the State of the Union. Maybe the president doesn't know that when you start bragging about your gains, sometimes the trading gods don't like that. And so by bragging that the Dow was at 26,500, but in all seriousness, I think that interest rates going up and staying up and getting close to 3% on a 10-year treasury and short-term rates going up and the Fed saying we're going to keep raising rates, it's kind of spooked the market. So this to me is almost a taper tantrum kind of 2.0 where the market's going, we don't want interest rates to go up. But they're going up because the economy is getting better. They're not just going up to go up. And I think that's what really, the Friday sell-off was that. The Monday sell-off was more about these volatility products, these ETNs, these reverse volatility ETNs that are basically in a non-existence. And it's the tail wagging the dog. Those products have caused more volatility than there needed to be. Now that that's behind us, you go, okay, well, then the market should be going right back up. And it tried a couple of days ago on, let's see, on Tuesday, we opened down and then reversed, and of course we finished. You can see a little green bar here. That was about the second biggest reversal that we had seen since 2011. Now, I'm going to show you in just a minute 2011 because this is real similar, but before we even do that, what's going on right now, while not fun, is unfortunately typical. And when I say typical, I mean this back and forth action that we're seeing. You might need to be prepared for big up days and more big down days where we look back and we see this number kind of situation like that. There's been a lot of psychological damage done in this market. And when I say that, I'm not being dramatic and going, Carl, calm down. It's just, it's just the stock market. But what I mean by that is, people that were buying right in here going, everything's great. And now they're sitting here with losses going, what do I do? And they don't have a lot of experience in the markets. They're freaking out. And so they sell down at these levels. And so there's a lot of just movement of money happening right now. There's margin calls at the end of the day. That basically means people that have been borrowing money to buy stocks, which has worked great, and all of a sudden it doesn't. The brokerage house calls them and says, you need to either put money in or sell your stocks. And so they sell their stocks at the end of the day. You see the volume here. So we're getting that. We're probably getting some forced selling, mutual fund redemption. So mutual fund manager sitting there gets the call that, hey, we've got to liquidate $3 million out of our fund, or $3 billion, whatever the dollar amount is. And they know they have to sell it because they got to literally send a check out to shareholders by the end of the day. And so what they do is they are forced to sell, but they wait. They want to see if the market's going to snap back. And when it doesn't, they have to sell at the end of the day. So that's why you tend to get this, if it isn't bouncing, it falls. And it falls quicker going into the close. Now, I do see a positive divergence, and let me switch screens real quick. So I posted this picture on Twitter today, and if you want to follow me, it's at Karl Eggerss is my handle, or you can also follow us on Instagram, post some of these pictures. But the picture I posted was a positive divergence. Now this is an hourly picture, so this is the 29th, and each bar is an hour. And so you can see we've only had one positive hour in the last, I don't know, 10 or 12 hours when the market kind of started fading yesterday. But here's what I'm talking about. We broke to new lows today. So as we were moving along here, and you kind of had this line in the sand that a lot of people were watching, when we broke down, the selling accelerated. But as we did that, there's a positive divergence in the relative strength index here. So that is some glimmer of hope. Now, here's the deal. When we get this oversold, what tends to happen is you're going to get some bounces, but there's also people who want to sell into those. So again, this is where that tug of war comes into play. And so what we need to see, really, I think, over the next few days, and I said this before a few days ago, is that, you know, we've had kind of these all or nothing days, right, where everything's thrown out. The baby's thrown out with the bathwater. And that presents opportunities if you buy individual stocks or sectors, because everything's going down. And so what happens when everything's going down, you cherry pick things that look good to you. And so we've been doing that little by little in various ways. And here's the thing. As you do that, what's going to happen is you're obviously either lowering your cost basis in some things, but you're going to get some bounces. So there's a lot of movement going on. But when it's this stretched, and you've had these all or nothing days where we've had basically all the volumes down, almost all the stocks are down, where everybody's just hitting the sell button, what we need to see, and I said this the other day, is we need to see the all or nothing day to the upside. We need to see everything going straight up. Now, you may say, well, didn't we get that here, which was on Tuesday? We did, but remember, it opened down, and when it opened down, it took a while for it to reverse, and then, of course, it kind of finished that way. So it wasn't a full day of just strength. But if we had two very strong days back to back, you know, and maybe maybe it comes up to here and we kind of backfill a little bit, now what you start getting into is this kind of box. And I'm going to show you 2011 because I think it may end up being this type of environment. So this is a picture of 2011. And if you recall, and I've referenced this many times over the years, because if you recall, we were humming along, everything was great, and all of a sudden the market went through a pretty nasty drop. So here we were in May of 2011, and then out of nowhere, our debt gets downgraded, right? We lose our AAA rating on our bonds, our treasury bonds. The pristine U.S. never lose money treasury bonds lost their AAA rating. And the stock market went through a really nasty fall in August. Now here's what I want you to look at is this time frame right here. What happened was, and I think we could be right in here somewhere, but what's happened is once it fell out of nowhere, everybody freaked out, and then it was like, wait, everything's fine. Market bounces and falls again and even goes up higher and think, okay, it's over. Look what happened here. As we fast forward, and this, by the way, took about 2 months. This whole thing here took about 2 months. But look what happened. At the end of this, we were kind of forming this little box, right? And when it broke down, look what happened. All the stops get triggered, and we actually fall pretty hard that day, only to see a reversal, and up we went, pulled back a little bit, and then we were gone to the races. I don't know if it'll play out exactly like that, but what I want to show you is that these days, while they don't look very big to you, these little bars here, those moves, believe it or not, and you can see the level at the time, the S&P, or excuse me, the Dow Jones was around 11,500. These moves were 4% moves, okay? Excuse me. 4% moves literally each day. So we had 4 back-to-back 4% days. We had a 4% down day, a 4% up day, a 4% down day, and a 4% up day. I mean, the volatility was crazy and scary, and then we kind of settled in a little bit, but once it fell here, that was like, oh my gosh, now it's a new level. We are kind of seeing that on a mini basis right now, is that we fell, and then it bounced, and then all of a sudden we get this, and we fell a little harder today, right, if you were to use today's charts. And so it's not uncommon for us to do that and start to actually flush everybody out. But remember, let's focus on what's going on right now. We have a economy that's doing very well. We have interest rates that are rising because of a better economy. Were things stretched? Sure they were. I mean, if you look at I've got a picture of here. This is the weekly relative strength. You can see it was above 90. Very high, very unusual. And so we kind of had this really almost look like, not quite like Bitcoin, but a parabolic move up. So for us to pull back is not shocking. Did some people expect this? Maybe. We had been raising some cash actually in December when we started to get this. So not in a big way though, because we're still not overly worried about it. And if you would have asked me what I thought would happen, I would have thought we'd have a more mild pullback and maybe a sideways pattern, we just didn't make any money for a while, kind of like back in, 15 and 16, something like that. But that's not what we're getting. We're getting something that is pulling back harder and sharper, and it's scary. But if you look back where we are, we're giving up gains back to November, December. Not fun, and a lot of money, and real money. But this is when opportunities happen, because I would rather see a 1,000-point day, as negative as it is and as not fun as it is, than to have 10 100-point down days. Because that doesn't cause the fear. And what happens is when the fear spikes, which we've seen, the fear spiking, that's what causes opportunities. That's what causes where you really start to get, I think, irrational behavior. And that irrational behavior is where opportunities come from. I mean, irrational to the upside, irrational to the downside. So there are things to buy right now. If you're fully invested, there's not. Would I switch, and I've been buying, but would I switch allocations right now? What do I mean by that? Well, if you're somebody that is 50%, let's just use a real simple example. You're 50% of your portfolio is in bonds and 50% in stocks, okay? Which I wouldn't recommend necessarily for most people because there's other things to do than bonds. But let's just say 50% in safer money, 50% in more growth money type things, capital gains oriented. If that is your allocation, is this the time to go, you know what, such a good deal, I'm going to go 70-30? I don't think so. If we had, are coming down and we're, let's say we end up coming down here, which would be 20,000 on the Dow Jones, which would be more like a, 6,000. You're talking probably about a little over 20%. Yeah, then we're talking something different. But we're not seeing that right now. Right? What we're seeing right now is a correction. And while not fun, is part of the game here. And volatility, what's been strange is the lack of volatility the last few years. This is not strange, what we're going through right now. This is not strange. What was strange was the lack of volatility and how we just consistently moved up all of last year. That's the strange part. This is the normal part of investing. But 3, 4, 5% days are scary. And so you have to have a plan going forward of what are you going to do. And you obviously don't try to sell on days like today or weeks like now. But you look and say, do you have any new cash I could put to work? Is there something that is holding up okay that may not in the future? And I can take advantage of something else that's beaten down. But I wanted to draw your attention to 2011 because this is very, very similar in my mind, where we were going along pretty good and then boom, it just fell, and that was about a 21% drop. So again, 21% would be like 5,000 points on the Dow. So it is possible, and remember, we've now had a 10% correction. A 14% correction is the average correction going back to the mid-80s intra-year. So, could we go down another, we've gone down, let's call it about 3,000 points. Could we go down another 1,500 and have a normal correction? Yes, we could. And so that is possible. But we will have some days that bounce very hard as well. But to end this thing, what we look for is some back-to-back or real close together ultra strong days. And then we get out of this, exhaustion of all this stuff going down together. So this is rare, and I would also tell you that this is rare to have a bull market end like this. Bull markets don't end this way. In fact, there was a note out today, and I don't necessarily disagree with it, saying that maybe we're starting the topping process. And what does that look like? Well, that doesn't mean it goes straight down. What that means is, could we start bouncing around in here, even make new highs? But when we look back, we will start to see that maybe ultimately this was the parabolic move ends and we start rounding top, because bear markets do round over. They look kind of like this, right? That's what over several months. Bear markets do not end, or excuse me, bull markets do not end this way where they just go straight down. That's not how bull markets end. In fact, this kind of pattern, the drop we've seen, is very, very unusual. So again, check your allocation. Don't adjust it, but preferably you've had the allocation set for you by an advisor or by somebody else that is appropriate. If you should only have 20% of your money in stocks, that 20% is moving, but it's only 20% of your portfolio, right? If you should have 100%, you're going to put up with more risk, but that's probably because you're younger, or you can accept more risk, or you have capital on the sidelines to put into the market. So I hope that helps a little bit. We'll see what the next few days brings, but obviously we're looking for some selling exhaustion, and then the other side of that is extreme intense buying, similar to what we saw on Tuesday coming into the close, but more so kind of, we gap down in the morning and then it just runs the rest of the day and doesn't give people a chance to get in. That's what classic bottoms look like. But even so, I don't expect this pattern. If you look at this on a weekly basis, I don't necessarily expect this pattern just to go straight up. I think that would kind of be unusual as well. As I said from the get-go, the psychological damage and people questioning whether the bull market's over is going to last for a while. So, kind of this situation, it'd be more normal where we're sitting there in a range between 26 and 23,000 or 24,000 and just bouncing around in this range while things are adjusting. And again, there may be some sectors that are breaking down, some ones that are taking off. There's still some things we've had. What I believe is, and we'll talk more about it on the weekly audio podcast, but more really rolling bear markets. We saw energy a couple years ago. But there's a lot of things that are left at retail, but there's things that are left that are vulnerable. Technology is vulnerable. We've obviously had some other areas that are vulnerable. I think utilities are starting to get hit real hard, which we had anticipated for a while, and you're seeing that. REITs, there's some income things that are susceptible to getting hit, but maybe it's a rolling bear market, not like what we've seen in the past week where everything goes down. All right, guys, don't forget eggerscapital.com, and also our audio podcast on there as well. So go to eggerscapital.com if you need our help, 210-526-0057, and we'll see you on the podcast this weekend.